Welcome, guys, to our monthly session training, Lunch and Learn. Welcome again. Good afternoon. Today we're talking about niche loans. We'll get in a second why that's important. But before we continue, please silence all electronics. Let's make this as interactive as possible. It's all about educating everyone and ourselves. And I also want to introduce the team that's bringing this presentation. Over 20 years experience of helping home buyers and educating realtors. Sheila Newfable, Maria Tinoco, Magala Sapien, and myself, I'm Omar Havich. Let's begin. All right. So what's the goal? Why are we doing niche training? We thought it'd be a great training because a lot of people either don't know about it or know very little about these products. So if you know more about these products, how can that help us? Basically, we can match more loans to clients. That means more real estate transactions, more closed transactions, and that's a plus for everybody. So we're going to talk about some niche products. Talk about 4 National Reverse Mortgage, 12-month bank statement program, 4 National, ITIN, Homeready, Homepossible, VA loans, 100%, DACA, P&L program, Investor Advantage, and Home Style Renovation. I hope everyone's excited.
Yay!
I want to remind everybody we're on a dual audience. We have live and we have webinar. If anyone has questions on the webinar, feel free to ask. Just type into the screen, the chat box, and we'll answer your question. All right, talking about reverse mortgages. I heard a terminology. It was basically who fits into a reverse mortgage? You know, yeah. And the guideline is really 61.5, and most investors are at 62. And the good news about reverse mortgages, they do fit a certain bar very well. Usually someone who's on a fixed income, someone that doesn't have kids, that can take over the property so they can get help. And there's people out there that have a lot of equity in their property and they want to utilize it. You know, let's just say they're 68 years old, they have a fixed income, it's only supposed to be Social Security income, and they have, $500,000 worth of equity. I mean, they can use this money and have no mortgage payments and then use the rest of it to enjoy the rest of their lives while they're living. Excuse me. So this type, they qualify you. They do look at credit, and not so much. They do look at income, but not the way a normal loan would be. They don't look at debt ratios per se. It's all based on their age, versus how much they owe and how much their house is worth. I do want to mention that there's 2 types of reverse mortgage. There is one that's an FHA loan, which goes up to the county loan limit, and there's one that you call a high balance, jumbo reverse mortgage. They're underwritten very differently, but they do apply. So if you have someone that, let's say, the house is worth $1.5 million, they're not going to be put on an FHA loan. So just keep that in mind. There are 2 types of reverse mortgage, although generally the guidelines are the same. The 62 years apply, and so is everything else. 1 to 4 units, like I said, is an FHA loan, also a jumbo loan. I wanted to give you, as a realtor, how you can help someone that's 62 years and older. What you can do to sell them in regards to, like, say they have a house with a pool, it's just them, 3-bedroom house, and they're like, wow, I'm here 68 years old, they're having some medical issues or so on and so forth, they're slowing down. You can help them downsize. I'm not sure if you've met folks out there, but a lot of times you get older, you don't want to do yard work. You don't want to clean the pool, you don't want to manage all that kind of stuff. So I wanted to give you an example of what it would look like for someone that is selling a property and wants to get, say, in a condo. So this scenario right here, 73-year-old borrower, they'll have a property, it's worth $750. They net $550,000. They want to buy a condo for $600,000. In this situation, in an ideal situation, they meet the requirements. They don't have, their credit's not serious derogatory. They have decent credit. They could put $326,000, $500, new mortgage of $294, and they have no mortgage payments for the rest of their lives. Now they have, $2 $225,000 that they can use for anything. So it's there are ideal clients out there. The terminology I was referring to is an elder orphan. That's actually an actual terminology for people that are downsizing. An elder orphan is someone who doesn't have kids, and it kind of meets that requirement. So, any questions on reverse mortgage?
I do.
Yes.
They would still have that equity left over, right? Just in case.
They would, and usually the way it works is it really depends on the investor. But usually they'll get so much up front. They might get $68,000 at closing, and then they'll get a credit line available to them 13 months later. So that's usually the way it works. Now, if it's someone that has a lot of derogatory credit, because they're going to look at the responsibility of how someone's credit is, not so much like a regular loan, but a reverse mortgage, they're going to say, well, if they don't look like they're responsible and they have a lot of derogatory credit, then what we're going to do is we're not going to allow you to be responsible for the insurance and the taxes as well. Because if you don't pay the mortgage, that's one thing, but you still have taxes and insurance you have to pay.
Yeah.
So if they don't feel you're responsible and it's a manual underwrite, they're going to say, now we're going to collect what we expect your life what we think your life expectancy is going to be. So if it's 20 years longer, based on actuarial charts or tables, then they're going to multiply 20 years of insurance, 20 years taxes, and that actually cuts the amount of money you're going to get back. That could be another $90,000. So it is relative. So any other questions?
Do they usually impound that for the insurance and property taxes automatically?
It's not really an impound because you're not making a payment.
Oh.
Yeah, there's no payment. So again, the big thing is someone downsizing, no mortgage payment. I'm just give you another complexity of someone that has bad credit. All right.
I just want to share something with the reverse mortgage. How it affects us as brokers that are prospecting is you have to be looking for the client that has a house in that price range and they're bigger and they want to downsize. If you're door knocking in the area that you want to list, it's not going to work for us. We got to look for an area where the homes are a little bit larger, like 2,400 downsizing to 1,500, or otherwise it's not going to work for us.
But just to be clear, so that is true. But in regards to the requirement, it's not. You don't necessarily have to downsize. I'm just giving you a good idea. I mean, this is not about a bigger or smaller property. This is just as long as you qualify with age, equity, and you have the money. So I'm just giving you a good approach as a realtor. You're going to meet an elderly person that wants to downsize because they mention this kind of stuff. It should trigger, whoa, reverse mortgage. This can really help someone like that.
I had a client that told me that in reverse, or please help me understand. He has 2 units and he can do a reverse mortgage. And I'm seeing up there it's 1.4.
Yeah, so it could be there's a lot of other factors too. They're going to see, again, because they're looking at age and how much they owe and how much it's worth, I don't want to give you a concrete number, but they're usually something looking at depending on, if you're like 62 years old, you need a lot of equity to make this work, because they're going to expect you to live another 25 years. Mm-hmm. And understand the balance of these loans are growing as each month goes by because you're not making mortgage payments.
Right.
So this kind of makes sense for the lender.
Okay.
So that makes sense. Okay. Any other questions before we go on? Good. Awesome. Okay. Bank Saver program. It's been out for a while. Maybe none of you have actually had a client that's done this program, but the Bank Saver program is really good for clients that are self-employed and they write a lot of stuff off. I know no one here in this room writes a lot of stuff off, right? Because you want to pay taxes to Uncle Sam, right? But there are a lot of clients that are self-employed that write stuff off. And what's cool about this is they're going to require a certain FICO score, 660. The common loan to value is 80% usually. It really depends on the investor. But we have one investor that goes up to 85%. I want to clarify, these are manual underwrites. A manual underwriter means it's not automated, meaning there's a physical person looking at that, and it's up to, which we call an underwriter, and it's up to their discretion to say, I want more or less. So there's really no golden rule. Yes, we could say it matches, but if they see something they don't like, they could ask for more stuff. So I hate to say it's not the easiest loan sometimes, but normally they want a CPA letter. They want to say that you've been in business for at least 2 years, either with a business license, a professional license, let's say a realtor, that you can show in your license, or a CPA letter to say you've been self-employed for 2 years or longer. Now, bank statements, they're going to look at usually one bank account. If it's your business, they're going to take 50% of the deposits. and not transfers, so you can't be transferred from account to account, all right, that'd be great, right? And then 100% of your personal account. Let's say you're a realtor, you're not incorporated, you deposit all your account in one checking account, they'll take 100% of deposits. So that's pretty cool. And again, because it's a niche loan, it's not like your agency type loans like Fannie Mae, Freddie, or Ginnie Mae. The rates are going to be a little bit higher, maybe 1% higher. It depends on your FICO scores. Obviously, someone who's got a 700 FICO score is going to be better than a 660. And usually it's not a 30-year loan. It's going to be somewhere between 5 or 7 years. Again, there's a lot of variety of investors that offer different criteria. So there might be someone that offers a 30-year. We're just trying to give you an idea. This is out there, and it's something like this. They're very close to, depending on what investor you go with, right? And you're going to be charged. This is a borrower-paid transaction, meaning like we have to charge. We get charged, and we have to charge our clients to do these type of loans. So niche products can help you close more deals, but they're not. You can't compare them to agency type loans. The best rates. Yes.
How much do they want the deposits to be? Like your personal and your business deposits, how much money are they looking at?
So how much money do they want? How much are they looking at in regards to the deposit amount? It doesn't. They're not saying it has to be this or that. They're just saying if you're buying a property for this much and the payment's this much and this is how much debt you have on your credit report, you need a deposit. It's like an equation. They're going to plug it in, and we have actually a little Excel spreadsheet. You can just plug in the numbers, and you got to add up 12 months bank statements, and that's how you do it. It's not too complicated, and usually what I don't have on here is the debt ratios usually go about 50%. They go up to 50%. So sometimes maybe 55. Just again, because it's kind of like not an agency type product. You have private banks or investors offering to support this product. All right. Any other questions before we go on? Foreign national. So there are folks that come in from other countries and do business in the United States. Okay, and fortunately, this product has gotten a lot better. There's a lot of money out of overseas. They come and do business here, or they stay with family, or they stay at a hotel. Well, some of these folks say, you know what, it's gonna be smart for me to buy something, right? So they create these foreign national products for clients that are foreign national, not citizens. They're not working here. I want to clarify, they're not working here. They need to have a valid passport. The cash to close must be in a source location. So the money can be in a U.S. bank account. A lot of times it'd say it's in China, in an account in China. It's possible that it's a manual underwrite. So the underwriter might say, okay, give me a statement or a letter from the Chinese bank, or we got to get a document translated. That's also a possibility. But again, it's possible. Usually you get a 3-year fixed loan or 5-year or 7-year. You rarely see 30-year fixes. And again, what they're looking at here is they're looking for someone who's not really going to live in the property. This is more like another business investment for them. This is an extension of their business. They're coming here to do business here. So their property is considered business property, not a personal loan. So it's not looked at as a qualified mortgage, like someone buying a house and living in it. It's very different. And that's pretty much it. We're at the charge to make money again. It's a more of expensive loan. The rates are a little higher. 6.25, I've seen as high as 9.99, 9.99. It just depends on the investor. So you're going to see a lot of varieties of the same thing. It just depends. So what we have here is not 100% concrete, but it just gives you an idea. So yes.
So I know that there is, for instance, in one of the transactions I had, the owner lived in China, so there's only X amount of money that can be transferred here. So as far as just like the deposit, how does that work?
Well, unfortunately, I know I've heard that there's limitations, but I don't know enough to say if he's going to buy property here, will they allow more? There has to be certain exceptions, because if you're going to invest over here, maybe they will. But again, I don't know all the foreign policy in regards to that, so I can't answer. I apologize. I only know so much, but it's a good question for an accountant. Ask your accountant. So, any other questions? Yes.
Yeah. So it starts up a 3-year fix. So after the 3 years, it turns to adjustable. Or that's the term?
No, it goes to an adjustable. Yeah, it goes to an adjustable.
Okay.
I put those rates for the most aggressive pricing, which is at a 3-year. Sure. Obviously, the lower fixed term, the lower the rate.
Okay.
So, some people usually get in this and they're going through their citizenship or they're applying for a work permit or so on and so on. That might change from it's more of a temporary loan. While they're doing business, they get set up and then guess what? Now they can go into another loan product that we can talk about later that Magali is going to talk about. All right, any other questions before we move on? Next. So ITIN. What's the difference between ITIN and foreign national? Anyone have an idea?
Work permit?
Huh?
They file taxes.
They file taxes. So these are undocumented persons that work here. They're not supposed to work here. They don't have a work permit, but they're being good folks and they're paying taxes to Uncle Sam because eventually they want to, be citizens here, I assume. So that's what so they apply for this individual taxpayer identification number, short ITIN. They're undocumented, working and filing taxes. 85% with a 700 FICO score. So you say, well, we're here, they're not supposed to be here technically. They're undocumented, but they have a FICO score. It so happens that if they're using, if they're using this ITIN number, you could establish credit on ITIN. Isn't that right, Magali?
Yes,
Yes.
anybody, I mean, an item, they give it to you
Yeah. It says,
basically over the counter.
right, so, right,
And they start with a 9, so if you ever see somebody's social and it's a 9, whatever number, you know it's an item.
ITIN, right?
Yeah.
So that way you have to ask the uncomfortable question, just know if it starts with a 9, that's an item.
Right. I mean, I've encountered clients that own a business, and I'm not sure how they set it up, but they're making good money and they have everything established on ITIN. So either way, so you'll find them. Now, 700 FICO score, 85% loan to value. Usually it's less. I mean, it just depends. This particular investor is offering that. Usually it's around 80%. You might even see 75%. But again, it's up there. You get an idea what the rates are. There's this particular investor offered a 30-year, but you might see 3, 5, and 7-year fixes. You see the similarity. They're paying 1-2 points in a situation. They're short. They're not long-term loans for the most part, and they can vary in regards to underwriting. And I'm not saying they're impossible loans. Like I just did a 12-month bank loan program not too long ago, and Sheila has done investor, which is another product she's talking about. They're very doable. It's just that there's no hard rules because it's a manual underwrite. They could ask for something more. So just keep that in mind. And with that, I'm going to introduce Magali. She's going to cover the next set of niche products. Everyone welcome, Magali. Salsian.
Magali.
Happy birthday, Magali.
Thank you so much. So, yeah, we're on my birthday. So today we're going to talk about, in my turn, we're going to cover Homepossible, Homeready, VA, and DACA loans. I air quote DACA loans because you have to know that it's not just applicable to DACA, it's also visa programs. So this is the kind of chunk of the presentation that's going to cover niche product that will actually cover like the everyday consumer, right? So let's talk about Homepossible. We've talked about it before. Homepossible is a Freddie Mac product that will allow the buyer to buy with 3% down payment. And it's census tract driven. What does that mean? This is the counter product to FHA. And so Freddie Mac decided, you know what, we're losing out of business to FHA, so how do we compete? And the way they decided to do that was by census tract. So if the property you are listing or your buyer is buying sits in a low income census tract, this program will apply and they will be able to buy the property with a conventional product, 3% down payment. The magic of this program is that if the borrower credit and income qualifies, we can waive mortgage insurance. So unlike FHA, where the mortgage insurance is set for the life of the loan and it will never disappear, this program has lower down payments and no MI on a monthly basis or upfront. So it's a much better program than an FHA. The coolest part about our Homepossible loan is that it will finance 2, 3, sometimes even 4 units on this program with 5% down payment. So what you have to know about units is that on this program, it'll increase from 3% to 5% down, but still no MI upfront, no MI monthly. Now, if the borrower chooses monthly MI, the perk to it is that they'll have a cheaper interest rate, okay? So one of the things that I want you to make sure of on this program is that the one caveat is that it has income limitation. Because it is made for low income census tract, some census tract is gonna have income limits. But the cherry on top is that there are census tracts that have no income limit, which means that you can have a person earning $100,000 and still taking advantage of this program as if they were a low income buyer, okay? So where do we go to find the magic in this program? You get to remember this link, put it on your desktop, put it on your phone. You always have to have this link, because when you click this link, it's gonna take you to the Freddie Mac website, and you're gonna be able to see this little box here where it says enter complete street address. And by complete, I mean complete. It's even gonna ask you for like the city, the zip, right? If sometimes when you punch it in, it'll immediately pop it for you. Most of the time that's a good thing because it's probably gonna be no income. So let me show you, this is an actual live scenario that I just ran for a client. So we're gonna click the address. What you want is this box right here. If you look at this box is gonna have Homepossible income limit, and it's gonna say no income. Does everybody see that? It's a little bit small. Eventually you'll get this presentation, but here it'll say Homepossible income limit, no limit. What that means is that any buyer, regardless of how much income they earn, can fit the program to buy this particular property. Okay? Now, this property is a 2-unit property. Happens to be a duplex. So I actually did the math just now while I was waiting, because I was thinking, okay, well, what is the payment on this program versus the FHA program? So on this program, this particular client is gonna be paying $2,332 on this 2-unit mortgage. Taxes and insurance included. Okay?
That's good.
If we were gonna do FHA,
That's 2
payment-
units, so that's still, that's
2 units.
income, that's not including the income.
this payment on FHA is $24.91. So as you can tell, it's like a significant reduction in their monthly outgo just because we can do this program. Now, if this client goes to the bank is probably just gonna give them an FHA loan. Why? Because maybe they make more money, or maybe it's just an easier loan to do, maybe there's less steps. We will go the extra mile when we pre-approve your client to tell you if they fit these programs. Because that way you know, okay, well then, if I'm playing in Pomona, all of Pomona is low census income. Okay? If you're playing in South LA, all of South LA is low census income. Okay?
All of something? All of LA?
Pretty much all of South LA, think Compton, Inglewood, right? If you're going to the South Bay, that's a whole different conversation, right? So for example, in LA, Eagle Rock is gonna have an income limit at $69,000. So comparable to the purchase price, that amount is not gonna be enough, right? But if you're buying in Boyle Heights, no income limit.
You have to live there like an FHA?
These are owner occupied properties, okay? 12-month owner occupancy requirement. 12 months, that's a standard. That every note says you have to live in the property 12 months. When you do the 13th month, we don't care. We won't ask.
And also you mentioned that if you don't do the mortgage insurance, it's a higher interest rate.
Say that again?
You said if you don't take the mortgage insurance, it's a higher interest rate.
Right, so for
Can you
example-
refinance in a couple of years?
Yes.
Just close.
So here's the cool thing about this product. It works for purchase and refi. So I do a lot of loans right now where people have an FHA loan that is in this low census income tract, and all we do is refinance them Homeready or Homepossible. Because we eliminate their MI and we're giving them better rates than competitive market.
I feel like it.
So the rate on this 2-unit, 4.25.
Wow.
Yeah.
Yeah, it's like American loan.
With
Yes, the
no MI?
FHA Huh?
No MI?
No MI.
What was the FICO for this one?
What did I tell you, 662?
Yeah.
662. Okay, so this program is an amazing first-time home buyer program. You just have to pair yourself up with the right loan officer that's gonna know the tricks of it to tell you what works and what doesn't. Let's skip to the next.
Website again?
It's freddiemac.com. /Homepossible. The best way to find it is to Google Homepossible income limit. And Google will give you that link, you click, and all you have to do is put in that address.
And the most they can do is 467 on a home?
So here's the thing, she's asking about loan amounts. The 3% loan amount is gonna tap you out at conventional limit. So 453,100. But if you wanna use this program high balance, you need 5% down. So think about this program as either 3 or 5 down, but it's never gonna require more. Okay, whether it's units or single family. You just have to make sure you qualify under the income limit restriction. That's basically the only thing you have to worry about.
So buying the loan.
Exactly. Okay, so this is Homepossible
Wait.
through Freddie Mac.
I just put the link in our Facebook group.
Cool. Thank you, Paul. Homeready. Homeready is the equivalent of a Homepossible, just on the Fannie Mae side. I personally am not attached to this program as much as I am to Homepossible because this will not do units with low down payment. This one will only do 2 units and you need 15% down. So I'm always gonna quote you Homepossible first. Okay? The only difference is Homeready is gonna allow for higher DTI ratio. Homeready is gonna allow you to have a debt to income ratio of up to 50% sometimes. Homepossible, it's a case by case. Right now, we're underwriting something where we can't make it work at 42% back end, right? It may not like your overall profile. So when it's important that if somebody gives you a Homeready Homepossible pre-qual, or you have a buyer that has Homeready Homepossible, that the loan officer took the time to actually underwrite a DU or LP, to actually get an underwritten approval. Because otherwise, you may have your pre-qual, and then when it comes down to actually getting it approved, it's gonna cap you, and now you're in escrow, okay? So this too, go ahead.
Plus, it's really a lot more appealing to the listing agent when they see those automated approvals,
It
right,
is.
on your offers.
Yeah.
So that's,
And the cool part about this one is, for example, when I issue you a pre-qual on this file, I'm actually gonna also say that it's a conventional loan.
Oh, yeah.
So it'll
It's
make
more
you
appealing.
competitive versus the FHA, right? So on this one, you also have a hyperlink. It works the same way as Homeready. I'm not gonna show you one more time, okay? But just for purposes of time. But the thing about this program is that it will still do 3% down payment like the other one, okay? It just won't do units. Cool? Let's move on. Any questions about those other 2 programs before we go into VA? No? Okay, so just my recommendation to you, play with the website, go on the Freddie Mac website, punch in your own address, punch in different addresses you have, and see if any of those addresses give you different income limits. Okay. Next training is gonna be down payment assistance, and down payment assistance rides Homeready. So if you are trying to do down payment assistance, you may wanna become very familiar with the Homeready website, because, actually, can we go back one slide?
Yeah.
Click the go back.
how do you go back?
I don't know. Why don't we go back? Oh, keep the click is in the back. Maybe it'll help you. Go back.
work.
No,
It doesn't work.
this one. Oh, there. Go back one more. And click
Oh,
the
now it's
hyperlink.
working.
Click the hyperlink.
Now it's working.
Okay, so we're gonna hyperlink. Go here. On Homeready, right? I showed you how to do Homepossible. We're gonna do Homeready. Do the same address, 565 North Gordon, Pomona. Okay, this one also has no income limit. You see that? Okay. So that means that I can put this loan under either or, with the caveat that I have a 2-unit property, right? So then I have to remember only Homepossible.
Right.
Even though this one also shows green. Now go to Homepossible. And then punch in the address, 565. It's the first one, right? Sorry. Thank you. Search. Didn't like it. Search. And
We're frozen.
anyway, what I wanted to show you is that when you go on here and you actually the box has a link for down payment assistance. So if you may want to refresh the if you learn how to become a pro at this website, punching a simple address, that box that came up, remember when I showed you no income limit, also has a hyperlink that says, do I qualify for down payment assistance? Click that link and it'll show you everything that this property qualifies for in terms of DPA. Now, that the property qualifies doesn't mean your buyer qualifies. But at least you'll know when you're listing a property, hey, DPA is available for this property. So it'll give you a bunch of other buyers to,
Attract.
Oh, there we go, here. See this? See if this property qualifies for down payment assistance. Click that. I hope it works.
It's good for marketing on your listings. Like we can get you flyers to say this property qualifies for this.
Okay, well,
So you
it's
can
not
market
coming
it.
up and that's not a glitch we could fix because that's fatty. So anyway, again, oh, there we go. Down payment resource, find a program. So all it did was now it took you to down payment resource, you can subscribe, it's free, whatever. And then it's gonna go through asking you questions about whether or not this property qualifies for DPA. Okay. So this is a great resource for those of you who are trying to list or get more buyers at your listing. Now you have two links that I think are going to be really useful for you. Okay, let's go back to our presentation. Any questions about these two programs?
I'm just curious, what typically would make someone eligible for DPA loan?
Down payment assistance really has to do with income limit. The income limit's very generous. It's $128,000.
Yeah,
it's great.
For LA.
The problem with down payment assistance is in a market that's a seller's market, you're gonna have a hard time having somebody approve DPA. So down payment assistance is not gonna become a thing until we switch the market. But once we switch the market, I mean, we do those in-house all day, every day, and we've been trained on them. The problem with them is that they're advertised as 0% down, but the reality is that the client is gonna have to come in about $4,000 to $5,000 out of pocket. Because the closing costs are also, there's not gonna be enough, we're in a really high cost area. And they're borrower paid loans, which means that to do your loan, you have to pay points up front. Okay? Talk to one of us if you wanna know more, but we will have, our next training next month is specifically down payment assistance. Okay, so make sure you guys come to that. Let's talk about VA really quickly. VA is a very generous loan. VA is my favorite loan to do. It's a very easy loan to do. It writes conventional program FHA guidelines, which is really cool. It'll allow you to push your debt to income ratio higher. We can do them with as little as 620 FICO score. Some lenders will push them down to 580, but at that point it's gonna be really difficult because it's gonna trigger a manual underwrite, and manual always is a little more messy. So how to target VA borrowers. The only caveat of this program, the only issue with it, is that after you surpass the county loan limit, in this case LA of $729,750, you will need a down payment. It's a very tricky like math formula, which is when you need a good LO to kind of figure that out for you. But as long as you're under the $729,750 and the bar is eligible and they have entitlement left, we can do VA for them. I'll give you an example. I had a client who foreclosed a property about 8 years ago. They had used VA.
Mm-hmm.
When we tried to do the VA loan, their certificate of eligibility came back saying they had no availability because the VA hadn't taken care of removing that foreclosure from that profile. So don't assume that just because time has passed that has actually happened. So then we did the legwork to remove it for the client. And then the eligibility was restored. They could buy again 0% down.
Mm-hmm.
Okay.
But Dolly, if a VA person is trying to get their benefits together.
Yeah.
So that they can qualify for a loan, is that something you all can help them with as well?
Yeah, and it's a very simple thing. The benefit we need is called the DD-214.
Mm-hmm. Okay.
It's a form that basically says, where they served, how long, were they dishonorably discharged or honorably discharged. Obviously, we cannot do it if they were dishonorably discharged. Why? Because that basically means that they were separated without, in not good terms. So they're not gonna be able to take advantage of it.
Did they look at the husband who was in the military or the wife or both of them? She wasn't in the military.
So as long as one of the people on my loan is a vet, the spouse can come on my loan.
But the
The
729.
spouse solo can only come on my loan if the vet is deceased.
Yeah.
You understand?
Yeah.
So just, let's say, I'm sorry, but let's say we're married. Let's say we're married.
Aw, I
He's
feel
a
bad
vet.
for you, Magali.
He's a vet.
It's your birthday, remember?
Feels like mine now.
He's a vet. And funny, I'm married and pregnant, so. Worst case scenario for you. So he's the vet and I am his spouse. He doesn't qualify because of credit and income. So I cannot use his benefit,
Yeah,
even if I'm his spouse, to qualify that mortgage on my own.
but
Well,
if he
he's still
dies,
alive, he just has
but
better
if he
credit.
dies.
We just started this, already killing me off.
But if he's no longer around, then I am a surviving spouse. That changes the game.
Yeah.
I can now take advantage of his benefits as long as you live in community property. Otherwise, you need a court order, and that's a whole other conversation.
But wait a minute, so if the vet is trying to work on getting his disability stuff together, his benefits together, you can help him.
Yes.
As long as he has his form.
Yes.
Okay,
Yeah.
all right.
And by benefits, what do you mean?
So he's saying that he's trying to get all of his health care and all of that
Oh,
together.
Okay. So
Yeah,
let's get clear what that means.
okay.
When I say VA entitlement benefit, I am only talking about the certificate of eligibility, and that we can find online, because we have access to that VA portal, with the DD 214. So if you want to pre-qualify a vet, all we need is the same thing we would need for every other client, the 222 and the DD 214.
Got it.
But I think what she's talking about is disability benefits. He has to go through the VA.
So
all that.
he,
Okay.
yes,
Okay.
if the person is getting
Right.
disability benefits,
Yeah.
that's them.
Yeah.
We're
But
not,
no, but meaning like though, can he start the process
he
though?
can start the process,
so
but we're
that's
gonna
all.
go nowhere because
Okay.
we want him to be disabled.
Okay,
Why? Because if you have disability benefit, you do not have to pay the upfront MI to become
Yeah.
part of the VA program.
okay.
Because this too has upfront mortgage insurance.
Pamela.
No monthly mortgage insurance, but upfront mortgage insurance. Okay, it's about 2%, 2.25%. It's financed, it's not money that they have to come in with, but it's still money that they're gonna owe.
Okay,
Make sense?
got it.
So the two things you have to remember about this program, we need a DD 214, they need to have eligibility, and it has to be the vet or the vet and the spouse. Okay?
Question, so if they're refinancing a property that's, VA, they're refinancing, pulling money out, they want to move it to a conventional loan, and they want to use the VA benefits now on a new owner-occupied property, how does that work out?
So they can. So I can only have one VA at a time. The person can only have one VA at a time. So you have to, let's say they bought a property, VA. Eventually we have to refinance it conventional to get it out of the VA. I now have liberated the VA entitlement again, so they can buy again. It just has to be an upgrade to what they already had, or depending on the age, I would say a downgrade if they're older.
If, from a real estate point of view, a realtor's point of view, excuse me, if they're in escrow, the refinance, then a new escrow, the time it takes them to entitle again the loan, so you get the certificate of eligibility to fund your, to fund the new loan on VA. What's the time?
So the time between us liberating one and creating the other, in my experience, it took about 7 days. Days,
so fast.
not, business
Yeah.
days. So you have to understand that if you're doing concurrent for a vet, you're gonna have to do a 45-day escrow just to be on the safe side.
Now, Magali, is it ever to the vet's benefit to not use that and maybe use one of those other ones, the Fannie Mae, the income qualified?
Honestly, no,
Okay.
because the VA has the best rate on the market, no MI monthly, no down payment. I mean, this is a great
Clear.
loan.
Yeah.
I don't even know why more vets don't have access to it. And honestly, it's just
why.
because they don't know.
Mhm.
And as a realtor, if you ever see a vet come your way, I would give them priority.
Yeah.
Because the only thing that is out there that prevents you from thinking that this is an easy loan are the myths that are out there, really. But this loan is done like a conventional loan. We can sometimes clear to close these in 21 days.
Yeah.
Now, what
Because
can
you have the added benefit that we do everything in-house. Nothing goes to the VA. Everything is done here. We do it all online portal access. We have that. So you don't have to do a double underwrite.
That's awesome. So the question I have though is that you have so many condos though that doesn't keep up their certification. Can't you all enforce that, or do we need to be working to try to
The
enforce
VA
it?
certification, that's one thing about condos. Okay, when you are dealing with a condo, you gotta let your LO know.
Yeah.
Because I'm not gonna know if you're dealing with a condo unless I'm an LO that's gonna pull title. And I may not do that until you're an escrow. And at that point, if your condo is not eligible, then we cannot do a VA loan on that. At that point, it would make sense to do a conventional loan. So if you're a vet that wants to buy a condo, I'm probably gonna pre-approve you conventional also. Because the VA may not work because the condo may not be approved.
Right.
And that's not on us. That's on that HOA.
Right, but can't you apply for it, ask
We
them to do
can,
it?
I personally,
Uh-huh.
we tried it, you've done it once. How long did it take you to get it approved?
It took almost 4 months. to
Yeah,
get
they
it
say
approved.
that, yeah.
So it takes a long time.
Why do they let it
Takes a long
lapse? Because it's just not beneficial to them?
They let it lapse, because it requires, a lot of reserves. You have to have enough reserves in that HOA. And also because it's a tedious process that a lot of people just don't want to go through when they don't want, the reality is, people don't want vets or low-income people in maybe those condo complexes.
Okay.
That's really the honest answer. Because I don't see why they wouldn't just keep up with it to have access to more buyers.
Yeah, okay. Thank you.
Let's move on to my final product, because I'm running out of time.
They have to have 2 years of work experience. Employment after they leave the military, right? Or
No.
they count that?
No. Military, let's say you have somebody that was in active duty yesterday and today they are working, we take their income today. Military works for us as income history, employment history. Okay? So it's a very generous loan. Okay? Let's talk really briefly about the DACA visa program. As you all know, there are a lot of documented people out there. What is the difference between foreign national, ITIN, DACA people? Foreign national, think of it as somebody who does not have permanent stay or business in America. They're simply visiting and want like a fun home to come and hang out in. Okay, the funds are going to come from elsewhere. ITIN means you are undocumented in the United States, no work permit. Okay. The ITIN and your job are not going to be enough for us to qualify you for a loan unless it's under that specific program that Omar talked about. Okay, you're going to need higher down payments, etc. DACA is it's deferred action, deferred access child. I can't remember the actual thing, but what it is a person who was brought here by their parents who are undocumented, and the government said this child had no say in whether or not they came to America. So as long as they meet a certain qualification, we will give them employment authorization. The employment authorization card is what makes or breaks these deals. It looks like this. It's like the green cards of the 1990s. Okay? It'll say their name, who issued it, and what we're looking for is the category. Okay? Much like your ID that has an ID number, these also have what's called a category next to the card number. The DACA category is C33. If you see somebody or you're talking to a client that tells you, well, I have DACA, you want to make sure that you ask two questions. Do you have an employment authorization card? And does it have 6 months left of validity? And where you can tell when it expires is right here. As you can tell, they're very short term. They could be 12 months or 24 months. I have not seen one that's longer than 24 months. Okay? So if the person is documented, as long as they have a job for 2 years, down payment like every other person, have done taxes for 2 years, and they have this employment authorization card, we can do conventional loans, 5% down payment. We can even do conventional loans, Homeready, like I explained to you before. Okay? But they have to have this document right here. And it has to have 6 months left of life. Now, why do I slash it DACA visa? Because there are certain visa programs that will also allow you to buy. It's a very long list, but the majority of them are right here. A type EB. When you see this, let's say type EB plus I-94 plus 797, it means that you have to have this type of visa with this type of document with this type of authorization to work. Okay? So whenever you get somebody that's not a straight citizen or resident, don't kill them off as a potential buyer, but you have to know that you're going to need at least this to start.
Yeah.
And then we will take it upon ourselves to figure out what other things we need from them. Does that make sense?
Mm-hmm.
Any questions about the DACA program?
These are actual working people that have social security, they pay
Yes.
taxes. And
The difference between an ITIN person and a documented person is that the ITIN person went to a CPA and created that ITIN. A DACA person went to INS, applied for it to be documented, and were given a social security card with restriction and an employment authorization card. You understand the difference? So as long as they have DACA, they cannot be deported.
Now, do they have to live on the property for 2 years, even though their authorization expires?
So again, as long as they only have 6 months left, the bank is gonna let them borrow monies. Whatever happens after that, happens after that. If the government doesn't give them DACA again, we don't care. If they lose the property, it works like every other, they're like every other borrower. Does that make sense?
So the expiration date of the 6 months, the loan has to fund before that 6 months.
The
expiration.
application has to be within the 6 month window. So let's say somebody expires in December. You gotta get that person in escrow by June. Like in escrow, so that my application, when I submit for underwriting, is 6 months before the expiration date. Now, let's say that you have somebody within the 6 month window. All I need is proof that they are getting renewed, meaning documentation's been submitted and that there's history of renewal.
And they can show you a form.
And then, yes.
Yeah, because these are all job related here.
These are all job related.
They're tied to working in the United States. So
Yes.
those are all legit, and they're usually tied with the wife and the husband. So,
Yes.
Yeah.
And so these types of loans are becoming very popular with young people. The average documented person is about 26 to 28 years old. Okay, so when you're talking to someone young, when you're asking these questions, ask the question specifically. Are you a citizen, resident, or are you documented? Because it matters to us. It matters the type of loan we can give them. Cool, that's my piece. Any other questions, just email me about these programs. And I know that's a lot of information, but in reality, as long as these people have this, we can work with it.
Thank you, Magali. Yay. It's my turn, and you know what, I'm gonna pass these out because I need to bribe everybody, because I know we're gonna go past the time.
You need to stay away.
So,
How about the webinar program?
yeah, and the webinar, they'll get like, they'll get a brownie, yeah, they'll get a brownie emoji. And we also have a sign-in sheet. If you just put
That
your,
already went around.
yeah, and make sure you sign in because we'll send you all the flyers and on these products and the links. And you can put your address and I'll send you more brownies. Okay. So pretty exciting stuff so far, right? Like all the products that you can sell. I know it's a lot to take right now, to take in, but just the biggest key is that pretty much do not turn anybody away, right? If they say that, oh, I don't qualify, I'm this and that, just say, you know what, we might have a product for you. So think outside the box. Go ahead and click that. Think outside the box. Okay, so this one particular product we have is designed for the self-employed borrowers like ourselves, right? That same as the bank statement program that like to write things off, right? From, you know, your children's tuition and all that stuff. So on paper, you don't really make as much, right? It's so similar to the bank statements program, but this one does not really, well, I mean, what if you don't really have so much deposit? Like you're straight 1099. So this product does not require tax returns. Crazy, right? And nor 4506. So 4506, they pull your taxes and confirm what income you provided, right? So they do not need any of that. The max debt to income ratio is pretty aggressive at 49. And you can have gift funds, some primary and second home. Business funds are allowed for assets. And so this is a non-QM product. So the waiting periods on negative events is much better than the regular products. So what I mean by that is that if you have a foreclosure, BK, usually the waiting period is 7 years. But with this non-QM products, it's actually more appealing because it's 5 years, right? So crazy. So P&I reserves, do you have a question?
You mean
Bankruptcy.
Foreclosure?
Yeah, foreclosure,
Yeah.
sorry. So, and the P&I reserve requirement is only based on the subject property. Why would I feel like I'm yelling?
You're always yelling.
Sorry,
You are yelling.
I'm always yelling. I know, but it's so quiet.
No, you're fine.
I'm used to like at home where the kids are like talking and stuff, so I have to like talk over. But okay, so it's based on a 15-30-year fixed rate plus or 7/1 ARM, and also a 7/1 ARM with interest only option. And the starting rates for fixed 30 is at 6.375. And fixed 15 at 5.625, which isn't bad, right? So imagine this, like if I have to pay, if I do my taxes the normal way, and I don't really write off to show income, and I have to pay about $20,000, right? So you have to really do the math and see if it makes sense. Would you rather pay that up front, right, pay your taxes, or go with this program where the rate is slightly higher, right? So you have to calculate all your savings throughout the many years. This is actually, it could be a temporary product to where, you know, you'll keep this loan for 2 years while you're putting income on paper correctly. So this is a good way to put it. Okay, so non-arm's length are not allowed, which means I can't sell my home, or Magali can't sell her home to her husband, Gino. And
You can't kill them off.
yeah, you can't kill him either. So, and it's easy closing. It seems so complicated, but this particular lender that we send it to, like, does it all day, like hundreds of these, easy, very easy. And I've actually done one with Ahmed. Yes, I'm here. No, how are you? Okay, so I'm just gonna explain what kind of proof of income they are looking for. So they're not just saying, okay, I'm gonna approve you, you're not showing me income, but you're good. they are looking for something. So it worked. For self-employed borrower, all of these, I know it looks like it's a lot, but it's not. So it's a lot of like crazy verbiage. All of these 3 items listed below must be provided. Okay, so number 1, they need a business license for the past 2 years. All businesses that require a license. If it does not require a license, we just have to provide documentation. Not all businesses require licenses, business licenses, right? And number 2, they need a letter from the CPA or a CTEC or just an enrolled agent. It's really simple, on the business letterhead with their phone number, license number, to show that they have either, or proof that they have either prepared or reviewed the most recent 2 years of their business tax returns. And Magali earlier just made a good point that this doesn't have to be the current CPA that prepared your taxes. Like if you ask your current CPA, hey, can you type up something for me? And they say no, it could be another CPA, like Chen, that can say, hey, I reviewed the last 2 years of her tax returns. And yeah, pretty much. So it's either prepared or reviewed. So the CPA or any of those tax preparers can provide that letter, right? So it just has to be legit. It has to be in the letterhead. It has to state the name of the bar, the business, bar's name, percentage ownership, and so on and so forth. And then here's the key. This is where they're going to determine your income. The CPA or all those tax preparer, whoever, must provide a profit and loss statement. Sounds very intimidating, and you're saying, okay, if we're going to provide that anyway, they're going to see how much I made. So what's the point, right? This can be as simple as a document that you Google. If you just put P&L, right? They will accept that. I'm telling you, I did one for Hamed, and that's exactly what we did. And we sent it over to the CPA and said, look, this is all we need. You don't need to give us a complete P&L. Basically has to say profit 200, loss 100, you know, like just the basic. You don't need to give the whole detail of all the other losses. So it's really huge. Like this is like such a very, very aggressive product.
So what I'm getting at, what you're saying is that we're not providing tax returns or actual income.
No.
What makes this valid or acceptable as some source of income is that the CPA or one of those valid professionals can is creating for the client and putting their name and their signature and license number on it, basically saying, I've reviewed their P&Ls, but again, it's not audited.
It's
so,
not.
I mean, really,
not. It doesn't have to be audited. So if for applications dated on or before 6/30, you need the 2018 and the year-to-date statements, right? So they just have to say that this is the P&L based on the review that when I reviewed the past 2 years.
Now, do they have to show seasoned funds in the bank?
Yes, yeah.
Okay.
They still have to meet.
25% actually. Did you mention that?
Yes, no, I didn't. Go ahead.
Yeah, this is a 25% down program.
Okay.
So you're self-employed, think of us. You're self-employed, you don't declare a lot of income, you have a CPA willing to vouch, and you have money in the bank, 25% down, you can do this program.
Okay.
The only thing is, be mindful, because you said something like, oh, it sounds like illegal, right?
No.
No, it's not, because the bank may or may not call that CPA that signed the documents to verify. That already happened to me, right? So you gotta make sure that everybody is like on
the same page, yes.
So a good scenario for somebody was, let's say 17 is not so good, and it's in a situation where 18 is not filed. But 18, they made a lot more money. Their P&L is going to show a lot more money. They're given the P&L for 18. The CPA saw their numbers, and it makes sense. They made a lot more money 18. Guess what? This is a great product for them because they're not going to qualify, if 18 wasn't filed. If they're not ready, like some people are incorporated, they're just not ready to do taxes yet. So keep it in mind.
But again, you do not need to submit the full P&L. because you can just submit the unaudited one that does not have all the details.
Yeah, income, expenses, net,
Yeah,
net
that's it.
gain or net loss.
That's it.
That's simple, as
Keep
long as
it
the CPA
simple.
signs it.
Yeah.
Signs it for the license number.
So that's pretty exciting, right? I was so excited about this. I couldn't sleep.
Kind of confusing.
Right, no, I know because of all the verbiage, but it's really easy. Letter, business license, P&L, unedited, right? Okay, so this is, actually you can go up to 80%, up to $1 million. We can do 80 if you have a 720 FICO, still so aggressive, right? And so on and so forth. I'll click and that's pretty much it on the Advantage Program P&L. Any questions? Are you excited?
Yeah.
This actually works for us. Well, it works for me.
Yeah, it works for us.
Yeah. Jen, I need you to write that letter. Okay. Okay, so now this is Investor Advantage is similar to the Advantage program where you don't need any income documentation. And I have a little. So this is actually designed for the experienced real estate investor, right? Who's purchasing or refinancing investment properties. And they need to utilize alternative documentation. So the highlights, no employment or income listed on the 1003. Again, tax returns not required. 4506 not required. First-time home buyer allowed, but they must have 6 months history of managing. Again, shorter waiting periods on negative credit events. We talked about that. 7-1 ARM product with competitive rates starting at 5.375. That's crazy. Minimum FICO 2 is at 640. Here's a catch though. There is a 4-year prepay penalty, but you can buy it down to 1 year. Not really sure what the cost is. Probably like a point to buy it down. And then there's no cap on number of properties that you can have. Okay. So it's not driven by the debt to income ratio, right? So there's no income. You don't have to provide P&Ls or bank statements to calculate your income. It will be based, approval will be based on the debt coverage ratio. Sounds pretty complicated, but it really is not. And I don't even know I showed you the formula because it's confusing. But this other simple way to put it is the gross rent divided by the mortgage. You just need to make sure there's 115%. So pretty much that you're making 15%. So that's how you calculate the DCR. It's a new word, DCR. So if you want to buy a property and you want to invest, you want to make sure that the gross rent is more than the mortgage. Not just the mortgage, taxes, insurance, and everything else associated with it.
What's the down payment?
Huh?
25% down?
My next slide.
Oh.
And the rents that they'll be using to calculate this will be based on the comparable rent schedule from the appraiser. So you're not just making up the number. You're not just going to say, okay, this is how much it's going to rent out for. They need actual documentation from the appraiser to say how much it's going to rent out for. Pretty cool? We ready to invest? Yep. Okay. And they can go as low as 80% down if you have a 720 FICO and up to 4 units, so on and so forth.
So these programs, think about them to compartmentalize in your mind. Investor, creative financing, you better have a lot of money in the bank because they're going to want 20-25% down.
Yeah.
Okay, so that's where most of them die because the liquidity is not there, and then on top of it, you're going to need reserves if you have multi properties. Yes. So if somebody comes to you and they need these creative products, the first thing you want is a bank statement or an asset statement because we need to prove.
You need to make sure they have
money in the bank.
Yeah. So, okay, so the next and final product is the home style renovation program. This is actually, it allows the borrower to obtain a single loan to purchase property for any construction that's needed. And the value is going to be based on after improved value, right? It's almost like a construction loan, but not really, it's home improvement. The difference between this and the 203K loan, first of all, this is like really easy and fast to do, but you still need a licensed contractor, right? There's no minimum dollar for amount of repairs, and you can do luxury. Like you can do a pool or, you know, upgrade your kitchen versus a 203K loan, you can't. Okay, what else is another thing that's really important? What's that other
The
important thing? Yeah.
contractor, so on this one, the money that they're gonna let you borrow for whatever repair you're gonna make is gonna sit in an escrow account. So what that means is that the licensed contractor that you're gonna hire to do these repairs has to have the money to start your project up front.
Yeah.
And then they're gonna get paid through the escrow company. There is no such thing as, here's 50,000, hopefully you build a pool. You've gotta build the pool and then invoice escrow.
Yeah, it's like draws. You have to show proof that this is how much it costs and then they'll pay you back.
I'll give you a realistic scenario. Let's say your client wants this house, it's at a certain price, but the kitchen's completely outdated or dilapidated. Well, he wants the house, but he's gonna need another $25,000 to fix the kitchen. Well, this loan's gonna allow you to do that, because now you can buy the property, money's gonna sit in escrow, it's all part of the financing, you know? Normally, you wouldn't get that, so that's why it's specifically for that. So you can convince your buyers on certain properties that are not in the best of shape.
Yeah, so that's how it will benefit you. And then 10 more products and programs, and we're almost done. Just kidding, we're done.
Thanks, guys, for coming.
Thank you.